Hi everyone and happy holidays. Welcome to another weekly Forex forecast. My name is Justin Bennett with Daily Price Action, and in today's forecast we're going to talk about the euro, the pound, the dollar yen, as well as the euro versus the Australian dollar, and we're going to wrap things up with gold or XAUUSD. Markets are moving really nicely right now. Everything from the euro to the pound. The dollar yen just broke down from a massive level, and I'm going to introduce a new currency pair today I haven't talked about in a while, the euro versus the Australian dollar. It just broke down from a massive pattern and could be on the verge of a big move. So we'll get to all of that and more in today's video, so let's get to it right now. A quick disclaimer that today's video is for educational purposes only. All views are my opinion and are not intended as investment advice. Forex is a high reward, high risk business, and you should not trade with borrowed money or money you cannot afford to lose. See the description of this video for the full disclaimer. So first up we have the EURUSD, and this pair has been moving really nicely all year. We had the uptrend earlier in the year, followed by the multi-month consolidation between 116.15 support and this 120 resistance area. Now, I was actually getting long on this Friday candle, which I announced to members in the membership site, and I got in early here for a couple of reasons. First of all, I knew that the momentum was intact, and if this rally back here was any indication, there was a good chance that once we broke out, we would not look back, and that's exactly what happened so far. Furthermore, the New Zealand dollar actually formed similar consolidation as this right here. However, the New Zealand dollar is actually leading the euro by almost 3 weeks. So the fact that the New Zealand dollar had already broken higher, that was a big clue for me that the euro was about to do the same. So recently we've been talking about this 121.70 area. This was previously resistance, and the way the pair was just churning below this level told me that a breakout was likely. Back here, I said that this pullback was likely to be temporary, and sure enough, we got to move back into 121.70, and the pair broke out last week. So now that we've had a daily and weekly close above 121.70, I'd like to see this area hold as new support on a daily closing basis. But as I mentioned last week, even if we get a move into Wednesday's high, somewhere around here, that could produce a buying opportunity. Now, keep in mind too that Friday formed an inside candle. So if we look at Friday's session, it occurred within Thursday's range. So this candle right here fits within Thursday's range, which to me signals consolidation. So anytime you get sideways movement like this within an uptrend, that could be an indication that the euro wants to move higher. Now, in order to confirm this as an inside candle, we do need to see the euro move higher next week, take out Thursday's high before it moves lower and takes out Friday's low. If we see a move below Friday's low, it would invalidate this as an inside candle. However, that doesn't mean that the uptrend is over. We would need to see the EURUSD close below 121.70 and even 120 for me to change my bias here. And as I mentioned to members last week, this 123.30 area, I do expect sellers to defend it. However, keep an eye on how the pair reacts around this area. Because this level is a little more speculative than most, we could see resistance come in a little bit lower or a little bit higher. So the way the price action unfolds up here is going to be key in determining exactly where this resistance level is. So we could see the pair come up, find some resistance around the 23.30 area, maybe pull back a little bit, maybe churn sideways before breaking higher, but I still like the EURUSD higher up toward 125. That's a target I've had on my chart since October. And again, I remain long here from this candle. I've added to this position twice now through this consolidation, and I do want to add again sometime this week following either a breakout of Friday's candle or perhaps a pullback into Wednesday's high. The pound looks ready for a move higher in 2021. This is something I've been talking about now for weeks, where we have this falling wedge on the monthly time frame, and the pair does need to close a month above resistance right around 133.40. So until that happens, this breakout right here is speculative because, as I mentioned last week, you can't play a breakout from a multi-year pattern like this on the daily or even weekly charts. We need to see a monthly close above this area in order to confirm the breakout. That said, the weekly chart still looks bullish to me. I've been talking about this for a while now, where we had this kind of rounded bottom that formed a potential inverse head and shoulders. Now, there are 2 left shoulders and 2 right shoulders, but the implications here could be the same. However, the pound needs to get above this 134.80 area that I have been talking about for a long time. This is resistance, and looking at the weekly chart, you can see where the pair failed to close above it. Looking at the daily time frame, the pair did actually close above that last week, but failed to hold above it on Friday. So this right here to me signals that we need to see a weekly close above 134.80 in order to take on the 136.80 area. Now, my 2 cents on the pound is that even though we could see a big breakout in 2021, right now there are more favorable pairs to trade. The EURUSD is moving much nicer than the pound, as are the Australian dollar and New Zealand dollar. So just about every major currency pair, in my opinion, is moving better than the pound. So if you are going to trade this, you need to do so on the higher time frames, in my opinion, because the daily chart just isn't doing it. Again, we need a weekly close above 134.80 to expose higher levels, and also to confirm this potential bottoming pattern that's developed over the last few months. But I do like most other major currency pairs over the pound just because they're moving more favorably. The dollar yen appears to have broken below a massive level last week that extends from the 2012 lows. So I talked about this on the 9th and again on the 14th, and I know some of you are skeptical about this trend line that dates back from late 2012. So we have late 2012 back here. This was of course the March low, and it also connects with last month's low. And despite some people being skeptical about this trend line or the importance of it, if we move into the daily time frame and look at last week's price action, it becomes pretty clear to me. You can see where this trend line served as support back here. It also triggered this bullish pin bar last week, which I mentioned to members was not a buying opportunity. And the reason for that is simply the fact that the dollar yen, it's been carving lower highs ever since February. And so trying to buy this right now is ill-advised. There's nothing to buy here. So when this bullish pin bar formed right at support, it told me that this trend line was significant, okay, but it was not a buying opportunity. Furthermore, the pair had just been sideways for weeks. Anytime you get what you think is a buy or sell signal in sideways movement like this, you have to be really careful, especially when it occurs against the trend. So the only thing that pin bar told me is that the trend line is significant as support, which means if we got to close below that trend line, it should start to serve as resistance. And sure enough, Wednesday's session closed below it, and you can see where both Thursday and Friday retested that area as new resistance. So I continue to like the dollar yen lower as long as that 103.60 to 103.70 area stays intact as resistance on a daily closing basis. And as for key support, I continue to like this 101 area. I've been talking about this now all year, where on the monthly time frame you can see where this 101 area, or perhaps just above it, served as resistance through this area. It then flipped to support through here, support again, and of course it was the March low. So as long as the dollar yen continues to trend lower and holds below 103.60 to 103.70 on a daily closing basis, I like the pair lower toward the 101 support area. So the euro versus the Australian dollar is a cross that I haven't mentioned in a while, and there's good reason for it. Over the last few months, the pair has just been really choppy. It hasn't gone anywhere. However, recently over the last couple weeks, the pair has broken down from what could be a massive bearish reversal pattern. So looking here at the weekly time frame, you can see where we have a potential left shoulder over here. Of course, the head is this giant candle back here from earlier in the year when we had all that volatility. And of course, the right shoulder occurs over here. So if this pattern plays out, and if this trend line right here is the neckline, it means that the euro versus the Australian dollar just broke below that level a couple of weeks ago. So you can see where 2 weeks ago, the pair closed below this trend line that's been in play for several years. And last week also retested that level as new resistance. So as long as this area right around 160, 150 holds as resistance on a daily and weekly closing basis, I like the pair lower toward this next support area right around 157, maybe just above it. You can see where 157 was support through this area back here. But if this is in fact a bearish reversal pattern, 157 could be just the start. I wouldn't be surprised at all to see the pair trend lower into 2021, maybe down to 152, and maybe down toward the 146 area, maybe even lower, because if the height of this pattern, even if we use this candle through here and get rid of this volatility, even the height of this pattern through this area toward the neckline could indicate a huge turning point for the pair. So again, as long as 160, 150 holds as resistance, I like the pair lower toward 157, 152, and perhaps even the 146 area going into next year. Gold, or XAUUSD, looks like it wants to break higher any day now. So a few weeks ago, I mentioned how there was this potential channel that could serve as support down here somewhere between 1700 and 1790. All right, so if you saw that forecast, we pretty much nailed this because there were two locations of this channel support. One was where you see it now, and the other one occurred at this low down here. Now, of course, because we got the bounce through this 1750 area, that meant that this placement, as you see it right now, was correct. All right, so we got this nice bounce from channel support. And recently we did have a daily close above 1850. However, the pair failed to hold above it, and that area became resistance again for some time. Now, you may be wondering, why should 1850 be support now if it didn't hold back here? And the answer is on the weekly time frame. If we look at the weekly chart, you can see where 2 weeks ago, the pair failed to close the week above 1850. Look how it was support back here. The pair closed the week below it, and then 1850 became resistance. Last week, however, closed above 1850. So going forward, this area right around 1850 should serve as key support. And of course, resistance comes in somewhere around $1,900, maybe just above it, which is the top of this channel. And just looking at the daily time frame though, if we zoom out, this is something I've been talking about ever since gold started to trend lower and pull back from this 2075 high. So I mentioned how we have this uptrend that's been in place for several years, and this pullback, even though we had some aggressive sell-offs like these candles through this area, the pair has always been trending lower nicely against this uptrend. And what I mean by that is we never saw some massive capitulation from 2075 that would indicate that this is a blow-off top. Instead, this to me has always looked constructive. It's looked like a bullish continuation pattern ever since back here in September and October. And I still believe that. I still think that gold is going to do very, very well in 2021. I think that once this breaks out, we could see 2015, 2075, and even much higher levels going into 2021. In fact, just recently in a blog post, I mentioned how the measured objective of this pattern, if we use the March low as the beginning of a flagpole, all right, the measured objective here could come in around 2380. And that's simply taking the height of this flagpole and projecting that distance higher from this recent low. All right, so as long as this low around 1780 holds, the objective from this bull flag pattern comes in right around 2380, which could be reached in 2021. If you enjoyed this video, give it a thumbs up, leave your comment below, and be sure to subscribe to my channel. See you next time.